intrinsic value. The entire premium is time value, reflecting the investor's opinion regarding the likelihood that the stock market will go up during the time the call has remaining before its expiration date. In this case, the expiration date is in 7 days. That means it has approximately 1 week left of trading potential. If you were to purchase a call at the 57 level for 60 cents, in order for you to break even on that trade, the market would have to rise, the Qs would have to rise to $57.60 in order for you to break even. If it rose to $57, exactly the same price as the strike, you would lose the entire 60 cents of time value that was present when you purchased this call. If you were to purchase this call, the December 11th 50 calls, and it rose to $57, you would have a profit of the premium would be $7 for this 50 call if the market rose to $57 at expiration, giving you a value of $7, making you a profit of approximately 72 cents. So which is better? Well, in most cases, when you're buying calls, you're better off if you believe the market will rise over the time period that you are holding the call, to buy intrinsic value, more intrinsic value, and less time value. So in this case, buying the 50 calls would give you a profit of approximately 72 cents. If you purchased the 57 calls, you would lose 60 cents if the market rose to 57. Let's talk about put options. A put option gives the owner the right but not the obligation to sell a specific security at a set price during a set period of time. Exactly the same as a call, the only difference being that the owner of a put option is looking for the Qs to decline in price, and that's how they would make their money. In the same way that we purchased an in-the-money option for the Qs, the call option at the 50 strike price, we could see that if it rose just to 57, we would have a profit of 72 cents. If we purchased a put option at the 60 level and the Qs declined to 55, we would have a $1.04 profit, potentially, if we purchased the put at the 60 level. If it declined to 55 and we decided to buy this 55 put, and the Qs declined exactly to 55, since we are only buying time value and we are not buying intrinsic value, that 65 cents would be lost. We would have purchased that and we would have lost the entire 65 cents of our purchase because it landed right at our strike price. It would have to rise to, or have to decline rather, to $54.40 in order for us to give us a break-even point. We would have to be at least 65 cents in the money at expiration for us just to break even. That's why in most cases some of the strategies that people take advantage of are selling out of the money options, because they realize that for the most part the only thing that they're actually buying is the time value. They're not buying any type of real value or intrinsic value in the option itself, and they're going to let time work in their favor so that the option that they've sold generates additional cash for them. And that's one of the strategies that we're going to be talking about as we go along. So a call option, generally you want to purchase a call option when you're bullish on a stock or ETF. And the best way to purchase a call option is by buying intrinsic value and buying it in the money. And if you believe that a stock is going to fall, if you believe it is going to go down in price, then you'd want to buy a put option. And generally the best value put options are going to be in the money with some intrinsic value so that you can take advantage of the decline that you see coming.